Robschild, no investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Sorry I didn't get around to doing my show over the weekend. I was going to do one on Monday, but I kind of ran out of steam. So I'm back. It's Tuesday, February 18th, 2025. Today's episode begins with some charts that I recently added to my daily routine of things to check. I recently kind of cleaned up what I look through on a daily basis, got rid of some charts that I'm not finding to be as useful as I thought they were, and I added some that seem to be more useful, and I want to walk through some of this data with you today. It's starting with the Skew chart and the advanced decline line. If you haven't heard of it before, the Skew index is a very interesting little index. What it does is it prices how popular put contracts are, basically. So when put contracts get more popular, more people are going to be buying them, the premiums are higher, there's more people invested in out of the money put contracts. So in other words, people are betting more money now than they have in a long time that there is going to be a major market decline. Now, whether that happens or not, nobody knows really, but there's a lot of money betting on some major bearishness. If you look at the Skew index, this chart goes back to about 1990. You can see that we typically peak around, what is this, 132, something like that. We get down as low as, the low 100s. We are at a multi-decade high in the Skew index. There's a lot of money in put contracts right now. There's far out of the money put contracts, not just put contracts. There's a lot of money betting that the market will fall. Now, funny enough, there's also people selling these put contracts, and usually the sellers of all options contracts are, the whales, the megalodons. There may be big fish buying, big options contracts for various things, but it's the whales that are selling them. And the whales can oftentimes, control the price of the market so that they make sure all of these expensive put contracts don't pay out. But it can get to the point where if there's enough volume and if there's enough dumping, it can go on the other way. And the other part of this is that you may have institutions buying options from other institutions. It's hard to say exactly the full picture here. The main thing being, though, is that there's a heck of a lot of money in put contracts right now, including my own. I believe this measures the put contracts on the S&P 500 more than anything else. Correct me if I'm wrong in the comments below. My put contract position is on HYG, high yield corporate, and it's only because, if the S&P 500 goes up 30% and then back down 30%, well, your put contracts on the S&P 500 aren't going to print. But if that happens while HYG essentially, it can't go up forever. They're bonds. They can't just go way up like the S&P 500 can, but there's a lot of room to go down. So like high yield corporate has sort of a ceiling on it. That's why my favorite way to be bearish on markets is actually put contracts on junk bonds or whatever. So being at basically all-time highs basically today is very, very noteworthy. Again, there's more money in put option contracts than pretty much the past many decades at this point. The next chart sort of measures breadth indicator. In other words, you've probably heard other people, if you're watching this show, you've probably watched other people talk about breadth of the market. In other words, when the S&P 500 is going higher and higher and higher, how many stocks are participating in this whole, everything going higher thing? One way to measure that is using something called the advanced decline line. This website here, marketin.out.com, it has a bunch of advanced decline lines on various markets. The one I want to focus on is the S&P 500, just because it's the most common gauge as far as liquidity in U.S. stock markets. I guess it's a great place to really see. It's Mr. Market. Mr. Market is the S&P 500. That's the best way I can describe it. Anyway, I did want to just note on the advanced decline line, that's down here, it's the red line, and the blue lines up here are candlesticks representing the price of the S&P 500. I'm going to say, if you look back into November of 2024, you can see that we had a low here in the price and then a higher low later on in early 2025 in the price of the S&P 500, and yet the advanced decline line, we actually have a lower high, not a higher high. Equally, when we have this high here in December of the advanced decline line, where more stocks were participating in the price going up, we had, the price here around, just hitting the 6,100 level. Now, since then, we've gotten back into the 6,100 level, even poking our heads above it. So this is either flat or higher, however you want to see it in price, and yet the advanced decline line not showing nearly as much strength. I've been saying over and over again in more recent shows that there seems to be more and more cracks showing up in the market that I think shouldn't be ignored. And every time I see stuff like this, it's adding to my sentiment that the 6,100 range is likely a long-term top. But that's just me and my crystal ball. The next chart I want to take a look at is commercial and industrial loans, all commercial banks. There's different ways of measuring how much money exists. This is one of them. Commercial banks lend money into existence. And so in order to have real growth and real inflation in an economy, you need growth in commercial and industrial loans. You can see throughout history, again, with the Fred charts here, this current chart goes back to 1950. Every gray bar is a recession. As you can see, many of these recessions show weakness in the commercial and industrial loans of all commercial banks. The dot-com crisis, bubble blow up or whatever, we saw a decline pretty much at the beginning of that recession and continuing downwards. And the great financial crisis, we actually had expansion of credit in this market going up into the middle of the great financial crisis before collapsing out of it and going down. So, it's not the best predictor of recessions exactly, but, take a look at this area over here. Let's put this in full screen mode. By the way, if anyone knows anyone that works at the Fred, get rid of this reset zoom button, because the best part of the chart is on the right side. This is the most updated information, and we can't see it with this darn button here. It drives me crazy. But anyway, I'll highlight this. So this is the most recent move. So this goes back to 2018. As you can see, we had a major expansion of credit basically right during the crash of 2020, the COVID flash crash, I guess we can call it, and then spiking lower. The point is, more recently, have we been healthily expanding credit? No. Since January 2023, we've been going completely sideways, actually not going above January 2023 since January 2023. For 2 years, there has not been an expansion of commercial and industrial loans. I mean, obviously, with rates being higher, especially after rates going lower and lower and lower since 1980, I mean, in a very strict pattern, I mean, that's part of it. People are probably nervous about trying to borrow money at such higher rates, especially since they've been going down and being low for so long. That probably affects this market, but at the same time, it just says how rates are too high. We're not in a situation where rates aren't high enough. That's very clear from this chart. And for those people out there that are saying that, rates are just going to go higher and higher from here, I disagree. I don't think I don't think we're going higher and higher. I I recently watched a video from Heresy Financial. He has a YouTube channel. Really smart guy, really great stuff. I think he's completely wrong about this idea that we're going into this longer term debt cycle idea that he has, that the debt cycles, basically you have periods of increasing rates and then declining rates, increasing rates, declining rates. The only time that we see that happening is the 1970s. And then my further question is, okay, so then what marks the peak of rates? How are we going to get to the peak? For the 70s, it was the baby boomers finally slowing down, their purchasing frenzy. Again, I attribute pretty much all of that inflation in the 1970s being a demographics thing more than anything. We don't have that now. We don't have, if anything, people are leaving the United States in droves. Birth rates have, I don't think, ever been lower. There isn't a demand. There isn't an explosion of credit. There's not an explosion of people. Like, where is this inflation going to come from? Where are the rates? What's the force that's going to keep rates going higher? I don't see any. So that's why, again, I like TLT and long duration treasury bonds so much, because I think we are in a place where bonds are actually distressed assets. People that are selling these are selling them at a loss. They're not selling them and being happy about how much money they made by selling them. So that's why I like that position again so much. But anyway, I digress. Let's get through the rest of these charts. The most referenced data that we have regarding how much money is out there, because, if there's just expanding dollars, more and more dollars, then yeah, that's typically inflationary. It's at least not deflationary. So the biggest metric we take a look at is the M2 money supply. If we were in a true expansionary healthy phase, we would see this going up. The amount of dollars that exists just go up and up and up during good periods. What do we have happening over here on the right side of the chart? Well, let's zoom in. The most recent reading of this was from December 2024 at 21.5 trillion. And then that's not higher than the peak of 2022. So we're not going up. We haven't even, this is the beginning of 2022. So this is 2 years ago. We don't have more money in the system than we had 2 years ago. And yet the stock market has gone up tremendously. It's just another sign to me that it's overheated. The stock market is overheated. We're due for a big correction at the very least. Again, watching my macro show to really understand all of my viewpoints. It's a very important show. If you haven't seen my macro show, watch the macro show. All of my other daily shows are supplemental and insignificant compared to that show, in my opinion. Adding to this, the velocity of M2 money stock. All right, so there's what can cause inflation. Well, it's how much money there is and how fast is it moving through the system. How often are people getting money and then paying it out? If you take a look at this chart here, does this look like, good times? I mean, not to my eye. Since it's never been this low. And this chart goes back to 1959. Are we back to 2006 levels? Or even 2018 levels? We're not even back to 2018 levels of the velocity of M2 money stock. This is not saying that there's tons of economic activity going on here. Where are higher rates supposed to come from? Where is the further inflation supposed to come from? I don't see it. Not at all. Another chart I just wanted to bring up today, just because I added it to my things that I'm going to be paying more attention to. The copper to gold ratio. Now we can't really look before 1971 because before 1970, although this is interesting information by itself, we need to look past 1971 because that's when we came off of the gold standard. And so can we zoom in on this? No. Oh yeah, we can do it from down here. Okay, so looking at it from 1971, we can see, you know, when this goes up, it means that like things are expanding. People need copper because they're going to build stuff, and like the economy's booming and everybody's buying stuff. Everybody's doing things. What's going on with this ratio right now, the copper to gold ratio? It's very, very muted. In fact, it's near all-time lows. If I scroll in better, it'll show a little more clearly. We're near all-time lows of this this metric here. This is not, oh, the economy is doing great and things are heating up. This is another absolute opposite sign. Another very good chart that I added to my daily routine is the TIPS. In other words, Treasury Inflation Protected Security Bond ETF versus the price of gold. So normally this should function together, because if there's bad inflation, gold should go up and TIPS should go up. And yet what has happened more recently? So you can see this current chart view goes back to 2006. And you can see usually when the gold line, obviously that's gold, when the gold line goes up and the TIPS go up. When gold goes down, the TIPS goes down. And they move generally together. And yet since, again, like the end of 2022, gold has skyrocketed and TIPS has just stayed completely flat. It's actually diverged very, very far from here. And my question is, okay, so who's wrong? Is gold wrong, or is the TIPS market wrong? I'm not sure. A lot of times when you have things that are supposed to work together that go apart, they turn into, you've probably heard on other channels, they turn into what they call alligator jaws, where eventually, you know, they're pretty destined to shut one way or another. Either gold comes down, TIPS goes up, or they both happen simultaneously to get back, to revert, to have a true reversion. I would expect that to happen. My guess is actually that gold is in a little bit of a bubble right now, along with many other assets. But that's just me in my crystal ball. Another indicator as to economic activity is actually the Baltic Exchange Dry Index. It measures shipping rates for vessels transporting dry bulk commodities. If things were booming, everything was going good, this would be doing well. It would be high. It wouldn't be low. You can see this chart also on TradingView, the Baltic Dry Index. You can see right now this is at 806. This is the lower range of this chart. This is not high at all. And this is all while, by the way, why I'm bringing all of this up in particular is the fact that the S&P 500, Mr. Market sees something completely different. The S&P 500 is literally at all-time highs, and everything else is saying that there's no strength here. There's no strength in credit. There's no strength in loans. There's no strength in copper. There's no strength in the Baltic Dry Index. The TIPS market isn't sniffing out further inflation going higher. The advanced decline line is showing that the breadth of the market is weak. Everything is screaming that the 6,100 level is the top. But anyway, that wraps up that part of today's episode. There was so much to go through that I wanted to do. I started trying to make a show Monday, but I have more time today, so I'm glad I finally got through that. Anyway, I digress. Next thing on today's episode, the next big report is the PCE data, not till next Friday, not this Friday, but Friday the 28th. There's not really any major data coming up before then. So unless there's some big black swan event, there's nothing to really potentially shake markets up until that Friday. No major changes in the daily reminders. Watch macro update to 11:25. The next update of my macro show may include some of the charts that I went over today because I think they are also very relevant and very important, but these are even more core important from a core standpoint. This is the most important show. If you're going to watch anything on my channel, please watch this show. It's highly important to get your bearings as far as what's going on in the U.S. economy and markets. Also, no major changes in the crystal ball readings nor the Robschild portfolio. I also have separate shows for that. Watch the portfolio update to 11:25 to hear me walk through it. On to the charts, the SPX, starting with the SPX, the S&P 500 index today, closing all-time high. This is officially a close. Wait a minute. Is it higher than the high of this day? 61.28, 61.29.57. Yes, it is. So by this chart, we have a closing higher candle. This is officially very, very bullish for the S&P 500 on a very short-term basis. Can it reverse and charge right back down? Yes, but it took a lot of strength to get through that last high, and on a closing basis, it's starting to look pretty bullish. I don't know. Napoleon Dynamite just apparently wants to go this way. So, meanwhile, the so-called smart money, TLT, my favorite place to be. Where are rates going? Where have rates been? Last Friday, it was interesting. TLT popped back up into this channel, and then we went back down out of it. This channel is not super relevant anymore. I'm just going to delete those bars there, but we are sitting on this previous line that represented the head and shoulders, inverse head and shoulders on TLT previously, and so that's holding for the moment. More than anything, it looks like we have a battle here in this area in TLT. I had said previously that this looked like really, really bullish, and now it's starting to look more neutral than anything. So, we have a battle, and then we could explode up, we could explode down. Not really sure, but it is still my favorite place to be. Looking at chart patterns for the one way of trying to predict where TLT is going to go is using the 10-year Treasury note yield. Just a little trend line here going back to September of 2024 that was very clearly support that we broke and we're back under. This is kind of showing me that there's still a bit of a bearish bias on Treasury yields. It seems we've also recently developed this little channel here, this blue line between the blue lines, a perfectly parallel channel. When you have a rising parallel channel, a lot of times what happens is you actually break down to the downside. So this is suggesting to me that yields are still wanting to head lower. The dollar index, to my eye, especially over the past few days, is starting to confirm more, I'm going to call it sideways motion. This is not looking super bearish, and it's not looking super bullish. If anything, it looks like we might be in a channel. This could be seen as a bull flag, actually, which would mean that the more likely scenario would be to break out to the upside on the dollar. But for now, I'm seeing, more sideways action than anything else. Silver had been building this bull flag here pretty clearly, and then we had this huge, what some people call a topping tail. I learned from verified investing. Basically, people got real excited. The bulls were taking over. Silver was about to go to the moon, and they got crushed back down. A lot of pain there. And so for silver to truly gain more bullish strength, we need to see strength above the $33.40 level right now. As it stands, with the flag, increasing in length, and then after that event, it's not looking like as strong as it had been looking before, at the very least. Gold also struggling to get to back to all-time highs. The all-time high in gold was recently at 29.42 and 78 cents. And, you know, again, for gold to really get bullish here, we need to go higher than that. I find it notable that Bitcoin is still fighting in this same range, right in the middle of this parallel channel. To my eye, it looks like it is preparing for a major breakout. To go this closely sideways, there's a huge fight going on, a battle, epic battle in Bitcoin. I expect the end result to pop out of this channel, as I've been saying in previous shows, and the longer this stays in this range, the more confident I am that we're preparing for a very big move in Bitcoin. I'm gonna say very big. If you follow the show, I am somewhere around 25% in equities, because that's what Benjamin Graham says. The minimum you should ever have of stocks is 25%, the maximum 75% versus your bond position. I have, minimum stocks, but I still have some stocks, just stuff that I think is undervalued, like Brazilian equities, because of the enormous dividend yield that they have and the extreme undervaluation, in my opinion. Anyway, that you measure it. Anyway, the point is we kind of built this bull flag recently, and then on Friday we popped out of it to the upside. This is looking very, very, very bullish to my eye. The Robschild portfolio has not been doing very poorly over the past week, and adding to the success of the Robschild portfolio has been KWeb. Got a pretty nice gain of almost 4% on Friday as well, and then today moving sideways. Again, KWeb, it's Amazon, Facebook, all out of China together. This is looking bullish as heck. We had this trend line that we popped out of. This sort of functions, I guess, as a confirmation, and we've just functioned exactly the way chartists expect, as a launch pad to the moon. Well, although not the moon, I'm just, like I've said in many shows, I'm just expecting the balloon that's been held underwater just to get to the surface. I don't need to get to the moon to gain a very handsome reward. Benjamin Graham would be proud. One piece of the Robschild portfolio that is not seeing the light of day yet is EMSOS, finding a new closing low today in the cannabis ETF. I'm still of the opinion that these companies are not going to disappear off of the face of the planet. I consider this industry to be the ground floor, as a new industry that will exist for a long time. I think the fear of these products are, it's becoming antiquated. I think we're headed in, despite whatever you think political views are, America has been accepting this more and more and more and more and more very recently. And it's not just, like the hippies of the 60s. It's mainstream. It's in the medical communities. It's being prescribed by doctors. My only question, there will be winners in this industry, which is why I like having the entire index. I don't want to try to pick which companies are going to do better than others, because I don't know. And, the tails are what really get the most gains. And so, I don't trust myself to pick the winners, but I own the winners if there will be winners by owning this fund. I've mentioned before on shows, my only question in this is, what are the winners going to look like? Is this going to be like similar to, the fanciest, most expensive wine industry, where, eventually they sell bottles for $2,000 or more a bottle, from the fanciest wine places? Is it going to be that kind of thing? Or is it going to be like a Coca-Cola, the best, I'm not sure how it'll work out, or maybe both. Maybe we'll have like a Coca-Cola and, your high-end, like super expensive stuff. There's money to be made. This is a commercial product that people will continue to use, however you want to look at it. So I'm still happily invested a very small amount of my portfolio. It's 2% of my portfolio in this fund, even though it's at all-time lows. I'm probably going to buy a little bit more right now in after hours to fill back up to the 2% level, actually, now that I'm thinking about it. And yeah, that's all for today. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.